Hello, good afternoon. Um, Distinguished guests, dear colleagues and students, ladies and gentlemen. I'm Li Ying. I'm the acting director and the executive chief editor of the Chinese University Press. It gives me great pleasure to extend to you all a very, very warm welcome on behalf of the press. Today, we are very happy here to celebrate with all of you the publication of Professor Lau's new book, The China-U.S. Trade War and Future Economic Relations, in both English and Chinese. Some of you may not know, this is the very first book dealing with the trade war with a very comprehensive analysis and insightful suggestions. The 2018 China-U.S. trade war actually is one of the most important, challenging, and urgent global economic issues of the year. It not only deeply influenced the bilateral relationship between the two largest economies in the world, the United States and China, it also brings huge uncertainty regarding the development and the future of the global economy. Now, at the beginning of 2019, I think many of us are still wondering, will the trade war end soon? We know we have the 19 days deadline until March, but we're really not sure what's going to happen after March. And secondly, if not, what will be the real impacts of the trade war, the ongoing war on U.S. and China, particularly on China, because many people actually already concerned about China's economic situation at this moment. Also, many of us want to ask, what's the real issues and potentially more fundamental issues behind the ongoing trade war? So it's with very special excitement today that we have Professor Lawrence Lau here to talk about his new book. And he's probably the most eligible person to answer all these questions for us. So I'm supposed to give an introduction of Professor Lau, but I do think Professor Lau hardly need any introduction here, as many of you are quite familiar with his work. So I'm going to be short. Professor Lau is currently the Prof and Claire Lange Professors of Economics at CUHK, and he served as Vice-Chancellor of the Chinese University of Hong Kong between 2004 and 2010. You can see his photo here. And before joining the CUHK, he taught at Stanford University for 40 years. And he's certainly one of the, I think, the top-ranked economists in the world, and with specialty in China and East Asian economies. So instead of repeating a very detailed CV of Professor Lau, I'm going to share with you several findings about Professor Lau that I was able to find out working on his book. Okay, so first, many of you may not know, in 1966, Professor Lau established the first econometric model of China, on China economy, when he was only 22 years old. Professor Lau, is right? Back then, you already start teaching at Stanford University? Yes, he was already a young professor at Stanford, and it's his biggest achievement at 22 to establish the first econometric model of China economy. In 1979, as a member of the delegation, I think along with Nobel Prize winner Professor Lawrence Klein, right after their visit to mainland China, that's at the end of 1970s. All the economists in the delegation were asked to give a forecast of China's economic growth in the future. So Professor Lau gave, I think, the boldest, probably seemingly quite impossible projection that China's economy would grow at an annual rate of 8%. And while others gave the projection could go as low as 1%. It turned out Professor Lau's projection is the most accurate. So we consider Professor Lau as someone who successfully really forecast China's economic miracle at the end of 1970s. And then in 1995, Professor Lau published an important paper, I think in a Japanese journal, academic journal, for the first time reveals the fundamental weakness of the East Asian development model. Because back then, the whole world was still very excited about the East Asian miracle, the very fast growth and development. But Professor Lau points out is actually, although the economic growth is true, but there's no evidence indicating that technology development or sufficient economic technology development in these countries. This is, I think this is well acknowledged by Professor Paul Krugman later on in his paper, showing that Professor Lau is the very first economist in the world having this surprising but very meaningful findings. After sharing this, I think we all believe Professor Lau has a very convincing track record, right? So, which makes me, and I think probably all of us, are really excited about his talk on the ongoing U.S.-China trade war today. So I will leave to Professor Lau to further share his insightful analysis and findings from his new book on how to fully understand the China-U.S. trade war. Let's welcome Professor Lau.
Thank you very much, Ying, for that generous introduction. And once again, I thank everybody for coming here today to listen to my talk. And also, I thank you for buying my book. but I should add something, because the press worked so hard on my book. I have waived royalties for the first 1 million copies sold. So I don't think I'll get any royalties, but anyhow, but I am very grateful for all of you for your support. Okay, now I will actually put this PowerPoint up on my webpage in a few days. Okay, and which I usually do, and you're welcome to download. One of the things that you might have already read is that the National Bureau of Statistics of China recently published that Chinese growth in 2018 was 6.6%. And this actually was even higher than the target. The target was 6.5%. But for some reason, the Western press was still very negative. You know, what you heard about is that this is the lowest rate of growth since 1990. Okay. In 1990, I believe the rate of growth was about 3.9%, 4%, something in that order. But we have to understand that I'll show you a chart a little later, that in fact, China actually has been stabilizing. You probably know about this L-shaped growth. And I think it is now on the horizontal part of the L. And if you really think about it, the trade war actually was threatened at the beginning of 2018. Okay, so even with and the tariffs were imposed, I think beginning in July, and then subsequently more tariffs were imposed. So the net effect was basically a decline from 6.8% in the last quarter of 2017 to the 6.4% in the last quarter of 2018. So it's about 0.4% decline. And I think that really illustrates what I've been saying, is that the effect would be negative, but it would not be very large. Okay, and I think if you look at, that's why in 2019, I expect Chinese growth rate would be still somewhere between 6 and 6.5%, okay, which is still a very healthy growth rate. You can see here that the growth rate has actually stabilized. These are quarterly growth rates, and you can still see some seasonality. That's why I put different color-coded the different quarters, but you can basically see that it has actually stabilized. Now, the one reason I wrote this book and wrote this paper is basically to try to reassure everybody that the Chinese economy will be able to survive the trade war. There would be some negative impact, but not a serious negative impact. I'll try to explain a little later, and that's why in the Chinese version it says 天塌不下来, which means the sky is not falling. Now I have to give you a little bit context why I said the sky is not falling, because back in 1997, you remember that there was the East Asian currency crisis, and at the time, I actually also wrote a paper saying that the sky is not falling. Okay, and I think in 2008, right after the Lehman Brothers collapse, I also wrote a similar paper, and I think what happened was that it proved that basically I was quite right in being optimistic about the Chinese economy. Now, I would actually go and show you that even though they're negative, the impact's negative, that at a maximum, it would probably be around 1.12%, okay? And that is a reduction of the GDP growth rate that is quite acceptable and tolerable by China. It's really completely manageable. However, I also want to say that even though by March, say by 2nd of March, even though there might be an agreement reached between China and the U.S., but the basic competition between China and U.S. for economic and technological dominance, I think that will actually continue. Now, even though I think that maybe it may not be China's intention to compete with the U.S. for dominance, but I think the U.S. being the number one power right now, they were always suspicious of number two for coming too close. Okay, so I think that is something that we need to take into account. The other thing that has really happened is the rise of populism, isolationism, nationalism, protectionism. All of this is a backlash against economic globalization, which we'll try to explain also a little later. Now, if you think about the impact, the immediate impact actually has taken place on the stock market. At the very top, you have the Standard & Poor, the green line, and that actually has not been much impacted in 2018. Basically, it's flat to the end of 2018. It began to fall only at the beginning of this year. But the bottom curve, the yellow curve, is Shenzhen Stock Exchange. Okay, you can see that by the end of 2018, it has lost maybe about 30% of its value. And then in the middle, you find a gray line, which is Shanghai, and then the blue line is MSCI China Index, which has lost about 20%, and then the Hong Kong Stock Exchange, Hang Seng Index, which has actually lost about 10% to the end of last year, and perhaps another 5% over the last couple of weeks. So this is actually very pronounced because the stock market is very sensitive to confidence, very sensitive to what's happening. But I want to tell you though that the Chinese stock market is not a very good barometer of the Chinese economy. Okay, if you really go back and look, they are almost disjoint. That's whatever's happening in the stock market does not really reflect what's happening in the economy. So there's no need to panic. The Chinese economy is not going to drop by 30%, just like the stock market. Now, this is the exchange rate. I want to show you the blue line. The blue line, actually, the red line. Well, first of all, the red line is the central parity rate. This is the onshore renminbi exchange rate vis-a-vis the US dollar. And going up is devaluation. So you can actually see that it has actually devalued quite a bit in, let me see if this works. Yes, this 2018 is gone up quite a bit and is reasonably going back down. Right, so you can see that the overall, it's actually gone at the peak, may have devalued by about 10%, okay, vis-a-vis the US dollar, and therefore also vis-a-vis the Hong Kong dollar, right, and during this year. But I think the thing to focus on is not so much the rate vis-a-vis the US dollar, but we should look at this rate relative to a basket, a trade-weighted basket of currencies. Okay, and this is the blue line. The blue line is what is called the CFETS currency basket. Okay, and full name is China Foreign Exchange Trade System. And that is basically a basket of currencies weighted by Chinese trade shares. And you can see though that the movement of the central parity rate is actually quite close to the movement in the basket of currencies. If you actually look at it more recently, this is from the beginning of 2018 to now, you can see that they actually track fairly closely. Okay, and I think that is really what we should be looking at. Now, one reason to understand this basket of currencies is the following. You see, if the renminbi follows the US dollar completely, that means whenever the US dollar goes up by, say, 10% against other currencies, the renminbi will also go up by 10%. But what is the implication of that? The implication is that if the US dollar goes up, even though the U.S. only trades with China, Chinese trade with U.S., only 20% of Chinese trade, China would be raising prices to all the other customers, all the other countries that import from China. And there's really no reason to raise prices to all the other countries just because the US dollar exchange rate vis-a-vis the renminbi has gone up. And similarly, when the US dollar comes down, if the renminbi follows the US dollar, that means it's going to reduce prices to all of us people, or for all countries that import from China. There's also no reason for doing that. And I think following the basket of currencies is the right thing. It really, roughly speaking, it means holding the purchasing power of the renminbi in foreign markets, holding it, roughly speaking, constant. So I think that is actually what the People's Bank is really trying to do. Now, I think one of the things we should realize is that China is actually a very large continental economy with a huge domestic market, and therefore it has a very low export dependence. The next three charts are actually quite interesting. If you look at Chinese trade, Chinese exports, if they fluctuate just like any other country. What I have shown here, the red line is China, and here's the red line is China. But you can see all the other countries in East Asia, in Asia, they fluctuate. Just like Chinese trade fluctuates like everybody else. Okay, and similarly, imports are the same way. They all fluctuate. You can see 1997, 2009, 2000, and so forth. The fluctuation's the same. Okay, same volatility in exports and imports. But what is really remarkable is GDP. See, the red line is China. You can see that even though they fluctuate like everything else, but it stay above zero, unlike the other countries that would actually be dragged below zero. So that really is why the what I said is that the Chinese economy is actually relatively immune to whatever happens outside. Now, this is also true for the U.S. If you look at the U.S. economy, it really is pretty much independent of whatever happens on the outside. And it's the same. It's actually true for most large economies because most large economies, the export dependence is low, and they also rely predominantly on internal demand. So that's something to remember. Okay, now this is what I want to show why we don't really need to worry too much. This is Chinese exports of goods and services, is the red line, and the blue line is exports of goods alone. You can see that it's actually been coming down. At the peak, Chinese exports were 35% of GDP, okay? And right now it's below 20%, it's around 18%, okay? Exports of goods. And this is the exports of goods and services and to goods, of goods alone, to the U.S. as percent of GDP. You can see that at the peak it's very high, and now it's actually gone down. Goods alone would be 3.4%. Okay, this is what I said earlier. Chinese exports of goods to the U.S. is only 3.4% of Chinese GDP. So that if you lose 3.4%, it's serious. You don't want to lose 3.4%. But it's tolerable. I mean, it's something that can be handled. But in addition, as I said earlier, the value added of Chinese exports is actually not that high, okay? And that really means that if you lose exports, you don't actually lose that much in terms of GDP. We'll come back to this point a little later. Now you can see here, if you look at the tariffs today, the U.S. tariffs basically apply to around 250 billion of Chinese exports, okay, at various rates, 25% for the first batch of 50 billion of exports, 10% for the subsequent 200 billion. There's a possibility that it might become 25%. But I want to say the following, that is, at 10%, basically, there's no profit. Okay, and at 25% is prohibitive. Nobody can continue to do business with a 25% tariff. And I think at 25%, what you will find is that most American importers will try to find alternative suppliers. Okay, maybe in Vietnam, maybe in Cambodia, Bangladesh. Nobody is going to pay 25% tariff, okay, I can assure you. So that really means that at the worst, China may actually lose 250 billion of exports, right, to the U.S. Now, what would it cost China? My estimate is the following. If you look at exports alone, on the value added of Chinese exports, on average is 25%. I actually, earlier, I tried to tell you that the value added on the Apple iPhone is very low. Okay, the value added on Apple iPhone supposedly made in China, but in fact the value added in China is very low. It's only about $20, even though the iPhone sells for about $600. Right, so it's extremely low. Although that is a very low value added. Some are very high value added, but on average is 25%. So if you multiply 25% with 1.7%, which is half of Chinese exports to the U.S., you get 0.43% up here. And this is my estimate of the first round effect of the trade war on the Chinese economy. Okay. Now, of course, that's not the only effect, because if you lose this value added, it will have second round effects. Okay, because there would be demand the inputs that you demand will have other demands. The total impact is about 6.66%. Okay, and therefore our conclusion is that the maximum, when all the effects are included, would be 1.12%. Okay, which is significant. Don't want to lose it. It amounts to 137 billion in 2017 prices, but it's actually tolerable. Okay, and I think that's the way to really understand the impact. Okay, now so this is a real impact on the Chinese economy. What about the impact on the on provinces, on regions? For example, Guangdong is a major export province. In fact, it's actually the most important export province in China. What is going to happen to Guangdong? Okay, let's go ahead and talk about Guangdong. Okay, in Guangdong, this is what happens. The Guangdong's reliance on exports to the U.S. is now only 8.7%. You can see that it used to be very, very reliant on exports. Okay, at one point it's close to 100%, but it's actually now come down to below 50%. But to the U.S., it is around 8.7%. So if we apply the same formula and multiply 8.7% by 0.25, that would actually give you something slightly more than 2%. So Guangdong would hurt a little bit more, but Guangdong's growth has been about 10% per year, and so a reduction about 2% is still quite tolerable. So what I'm trying to say is that everything considered is actually going to be tolerable. Now I want to come back to this slide. This slide actually is really interesting. It gives you an idea what might happen. The blue columns would be the percentage of U.S. apparel imports from Hong Kong, Taiwan, and Korea. Okay, the red column is the percentage of U.S. apparel imports from China. Okay. And the yellow part is the percentage imports from the ASEAN countries, all right? So mostly Southeast Asian countries. Now you can see that the growth of Chinese share is really at the expense of the share from Hong Kong, Taiwan, and Korea, all right? And I think eventually what would happen, actually this has begun even before the trade war has begun. What will happen is that the ASEAN, because of its advantage in cost and so forth, you can see the Chinese share is already declining, okay? Even before the trade war. So what will happen is that this will accelerate, and the ASEAN countries will, Vietnam, Cambodia, maybe Indonesia, would fill up the slack, okay? And that's basically what's going to happen. And it's going to happen with or without the trade war. The trade war would simply accelerate the process. It's going to happen. It happened just like China taking over from Hong Kong, Taiwan, and Korea. Okay, same thing. Because Chinese income is rising, wage rates are rising, and it cannot continue to make garments and shoes. Okay, and that's something that we should actually keep in mind. Now, I'm not going to talk about the other provinces because the idea is the same. And Shenzhen, you can see that even more interesting, because in 1990, exports was 250% of Shenzhen GDP, right? It's really come down. And now it's actually, I think it's around 11% by now. But I think it would survive. But I want to talk a little bit about Hong Kong. But with Hong Kong, it's actually, the following chart is actually interesting. This is exports to the U.S. from Hong Kong as a percentage of Hong Kong GDP. Now, what you can see is that at one point, the green line is domestic exports. These are exports of goods actually manufactured in Hong Kong, all right? And you can see Hong Kong was quite important in the early days, okay, this is at the peak, this is 1980, somewhere in the 80s, is more than 20% of GDP. This is export to the U.S., okay, more than 20% of our GDP, but it's gone down, really way down, and now it's almost zero, okay. Nothing is manufactured in Hong Kong anymore, okay, because it's just too expensive to manufacture in Hong Kong. Now, the total exports is the blue line, and you can see that the blue line actually coincides with the re-export. These are re-exports from China. Okay, so almost all Hong Kong exports to the U.S. actually consists of re-exports from China. Okay, this will be affected. This will be affected because re-exports from China will be tariffed, subject to tariffs, just like exports from China. Okay, because of the country of origin rules. So that's not going to. But the thing is that the value added, the contribution to Hong Kong GDP of re-exports from China is very low. It just, the ship comes in and then it goes out again. There's virtually very little re-export. So this is not going to be. So in terms of the tariffs, it really would not affect Hong Kong that much because there's nothing. Hong Kong basically exports nothing, no goods, okay? All right. Now, so what would be the impact on Hong Kong? I would say this is mostly indirect. One is on the stock market. The stock exchange would be affected, as you could, I showed you just a moment ago. But the second thing that would actually be affected would be potentially tourism, tourists from the mainland. Okay, to the extent that Guangdong is affected somewhat, and Shenzhen is affected somewhat, the number of tourists coming might come down, right? And their buying, their spending might decline. So I think it would all be indirect. It won't really be very direct. Now the impact on the U.S. actually of this trade war is even smaller. Even smaller. That's why someone in the U.S. said it's really a rounding error. So even though, it's negative on both sides, but because U.S. has a much bigger GDP, right? And so it actually it would be much smaller, the effect. Two numbers are important to note. U.S. exports of goods alone to China, because services are not subject to tariff. So only goods are subject to tariff. Okay, so U.S. exports of goods alone is only 2/3%. Okay, it's very low. So even though the U.S. value added is much higher, U.S. value added of exports to China is about 50% the first round, and cumulatively include everything would be about 88%. So it's much higher. But because this percent is much lower, if you remember that Chinese exports of goods to the U.S. is 3.4% of Chinese GDP. But U.S. exports to China of goods is only 0.67%. It's much lower. So if you do the calculation, this is exports of goods and services to the world, and you can see, just like I said, U.S. is a large economy. Export as a percent of GDP is very low. Okay, it's about not more than 12%. Of goods, it's actually not quite 8%. It's really very low total. And to China, I mean, it doesn't go past 1%. Okay, as I said, it's 0.67%. Although it is rising, Okay, China. So if you actually do the calculation, you can see that the impact on the U.S. GDP would be 0.34%, okay? And which is still much lower than the impact on the Chinese GDP. Okay, now the other thing though is that this assumes that all the exports would be halted, but you have to remember that not all the exports can actually be halted. For example, we know that in the case of Zhongxin, the cell phone maker, 90% of their SIM chips were imported from the U.S. So if you cut off the imports or increase tariffs, you're going to hurt Zhongxin, right? And you're not going to benefit that much. There are no alternative sources of supply. So I think it's actually very unlikely that it would be the full impact of 3.4%. I think it would really be at most half of the U.S. export will be subject to serious tariffs, like soybeans. Okay, and the result would be a reduction in the U.S. economy in the GDP of about 0.17%. It's really very much in the rounding error, so it's not going to be serious. But on individual groups, individual provinces, into cities in China, and even in individual groups in the U.S., they will be hurt. The farmers in Iowa, right, would be hurt because the soybeans that they produce cannot be exported to China because of the high tariffs. Okay, so I think that is really my estimate of the damage, potential damage of the tariffs on both countries. And you can see that they are negative, much bigger for China as percent of GDP than for the U.S., but fundamentally, basically quite manageable by China. It's not terribly fast. Now, the second thing I want to show you is the following, is that there is actually a great deal of disagreement about how to measure the U.S.-China trade deficit. Okay, and this is really because of the measurement differences. For example, the U.S. will count the Chinese re-exports through Hong Kong to the U.S. is included in the U.S. data of Chinese imports, but the U.S. will not include U.S. exports to China through Hong Kong. Okay, so the numbers really don't quite fit. So that's one thing, and then if you actually include all the re-exports and also include the services, the deficit, the real deficit, will come down to 376 to 254 billion. Still a large number. I'm not saying that it's a small number. Still a large number, but lower by quite a bit. Now, but if you take this number, 254, and you ask, if you calculate the value added of the exports to the two different economies, what would be the difference? If you actually look at the value added, what would happen is that this number will go down to 111 billion. Okay, because and the reason is what I said earlier, is that U.S. exports to China has a much higher value-added content than Chinese export to the U.S. All right, so if you actually look at value added, it's about 111 billion, and that actually is still a large number, but that looks like it's possible to close. Okay, it's possible to close because Chinese imports of energy goods, is on the order of 100 plus billion a year. Chinese imports of agricultural commodities also on the same order of magnitude. So you can imagine that in a few years that it is really quite possible to close this gap of 111 billion. So that's basically part of this book is really devoted to calculating these numbers and making sure that they're all right. You can see that if you reconstruct this, it is actually going to be much lower, like what I have done, and I think 111 is actually a reasonable number. Now, the other thing that you should remember is that U.S. runs a trade surplus in services. It sells much more in services to China than China sells to the U.S. So, and the surplus per year is on the order of 50 billion a year. So there's a large number. So if you put everything together, I think that we got 111. I don't think 111 is still a large number, I agree, but it's something that's possible. I mean, 376 just looks too formidable a number that you can close. Okay. Now, however, I want to also say the following, and that is the trade war is just the surface. The tariff war is the surface. I think what we really have to recognize is the fact that the China and the U.S. are actually now really competing in both the economic arena and also technologically. Okay, and because the as I said, Chinese GDP was only 1/5 of U.S. GDP in the year 2000. Okay, by last year, by 2017, Chinese GDP became 2/3 of U.S. GDP. You know, in a short space of 17 years, it went from 1/5 to 2/3. So you can imagine another 15 years, you know, it might actually catch up and may even surpass the U.S. in the aggregate. Okay, and I think that and I think there is some concern from the U.S. that this is going to result in a diminution of U.S. influence in the world, and in some sense you have to accept that is actually going to happen because any increase in U.S. and Chinese influence in the world is going to result in a relative decline in U.S. influence in the world. But it is still a big difference, both in terms of per capita GDP and in terms of technological levels, and so I think it will actually take a while. However, I think this idea of treating China as a potential competitor, actually is bipartisan. It's not just Trump. All right, you could go back and think about the pivot to Asia, okay, and the TPP, Trans-Pacific Partnership. These are all initiatives that are, at least in part, aimed at containing China, right? But they were started under President Obama, right? They are not. I mean, I don't know. Trump decided not to pull out TPP, but he has other ways. But he's still actually during his campaign, he actually was also very tough on China, even though he actually pulled out TPP. And Nancy Pelosi, representative, who's now the Speaker of the U.S. House of Representatives, she is actually also very anti-China for totally different reasons. Okay, but in any case, I think that the competition between China and the U.S. is likely to be the new normal. Okay, I think even Henry Kissinger, who visited Beijing a few months ago, he basically said the same. I mean, like I said, in the 70s and 80s, China was regarded by the U.S. as a potential ally, against the Soviet Union, right? But the Soviet Union collapsed in 1989, so the geopolitics, have changed completely, right? And besides, at the time, China was not an economic powerhouse that it is today, right? So I think that really is the backdrop, and we have to accept that this competition is likely to continue for a while. It's not going to go away very quickly. there is a professor, Graham Allison, some of you might know him at Harvard, at the Kennedy School, who actually has advocated a thesis that a rising power and the existing power, he said it's inevitable that they will clash. All right. He called it the Thucydides trap, and after a Greek historian who wrote the history of the war between Athens and Sparta. But I don't subscribe to his view. But anyway, that's what he said, and it's actually a pretty popular book that Graham has written. But I think a competition is actually inevitable. Now, not all competition is bad. I think that there is competition, technological competition in building the fastest supercomputer in the world. And last year, IBM Summit won the competition. Is the fastest. In 2017 and 2016, it's a Chinese computer called the Sunway Taiwu Lite that won the competition. And we don't know what will happen this year. But this basically is I think it's pretty healthy competition. And the Chinese computer actually was quite interesting. It was built entirely with Chinese design and manufacture components. Okay. Now, but I want to caution that if you want to build just a few computers and have manufactured special chips, you can do it. The cost can be very high, but if you want to do, to supply, say, 10 million cell phones with chips, then you really need very advanced technology, because otherwise the cost would be very high. Okay, now, so longer term, there are grievances that need to be addressed. One is the intellectual property rights, and I think that's improving in China, at least since 2014. I think it's going to get better because there are now many Chinese inventors, discoverers, and they all want to be protected. And I think that's going to happen. And basically, China would go through the same process as Japan and later Taiwan went through in terms of intellectual property rights protection. Okay, and I think that's going to happen. There is the issue of forced technology transfer, and I think that's going to also become moot very soon. Why? Because China is now allowing wholly owned subsidiaries of U.S. firms. Used to be, you want to establish a car factory, you have to find a local partner, 50-50. And then, you can't very well hide the technology from your local partner. But now you can be wholly owned. Like Tesla has actually a wholly owned subsidiary in Shanghai making electric cars. And BMW has bought 75% of its joint venture partner. So I think that is actually not going to be a serious issue. I hope that something can be done on the cyber theft issue. And I think basically, I think it's quite clear that all thefts by whoever should be criminal behavior and should be prosecuted by both countries. Thefts, cyber thefts are no different from ordinary thefts. So they should be treated in the same way. Okay. Now, I think the other thing is, national is basically control and foreign direct investment. I think it's going to happen. What is going to happen is that China has now a very short negative list of foreign investment, and I think that would help a lot. Negative list means the following. A positive list means that you can only invest in industries on the list. A negative list so if an industry is not on the negative list, you can invest in it. Okay, so negative list is actually going to be a large improvement. So I remain optimistic. I think one of the results of the tariff war is that China would actually become more open than before. I mean, President Xi said that many times, and I think they will actually, China will actually be even more open to trade and direct investment. Okay, because I think the biggest risk for China is actually to become isolated. Okay, and they just have to continue to open, especially in view of these pressures on tariff. Is the correct response is to be more open. Okay, now now let me. I think I want to leave some time for you to ask questions. So let me quickly go through some long-term forecasts. This is an interesting chart because what I have done here is to put down the rate of growth of real GDP of each country. The red dot is China, yellow is Japan, the blue is the U.S. Okay, and on the horizontal axis is per capita GDP. Okay, now we all know that as per capita GDP rises, the growth rate will come down. Okay, it's well known. Okay, people, when per capita GDP rises, people will take more leisure, they take more consumption, and growth rate is going to come down. But you can see here that the blue is U.S. and U.S. is way here now, 60,000. Japan is around here, and China is only here. So China is actually at the range where it can actually still be growing relatively fast, right? It will eventually slow down, no question about it. But it is at a low enough level of per capita GDP that it can actually continue to grow reasonably fast until it gets to around here, okay, about close to 20,000 per capita. It's now only 9,000. So there would still be a period in which China can still grow relatively fast. One reason is that the Chinese has very high national savings rate. This is a comparison of savings rate, and you can see that this is China, and this is Japan, and this is U.S. U.S. isn't safe enough, right? And the Chinese have very high savings rate. The other thing to think about is the following. If you think about the capital-labor ratio, this is basically how much capital does each worker has to work with, okay? And you can see that U.S. and Japan are similar now. They are close. But the China is still very low. Now what this says is that there's still a lot of growth, room for adding more capital to work with the labor, okay? And what that means is that productivity will continue to rise as you add capital. So, so I'm just trying to provide you with some details as to why I think China would continue to grow at around 5–6%, whereas the U.S. will grow at around 3%. And these are some of the explanations. Okay, this actually also shows you how much surplus labor China still has relative to the other countries. But anyway, let me come to the results. The result basically says that the Chinese aggregate GDP is likely to exceed U.S. GDP around 2031, 32. I mean, plus or minus a few years, but it would happen, okay? Because the growth rate would still be much higher than the U.S. growth rate, okay? But in terms of per capita, that's still a huge gap. You can see I have here 2035. It would still be a huge gap. And it won't be until the end of the century when Chinese real GDP can hope to approach U.S. Real GDP per capita. So in terms of per capita, it will actually still take a long time. And now, technological competition, I think this is very natural. I think it's unfortunate that national security considerations have now come in to technology in a real way, but there's not much we can do about it. I think China will have to develop its own advanced semiconductor manufacturing on its own, because I think that but actually all along there were restrictions on high technology exports from the U.S. To China. Okay, that's always been the case, right? And now it's going to be probably going to be even more stringent, and I think there's really not much, no alternative, but for China to actually to try to develop its own advanced technology. But China actually suffers a little bit by not investing enough in R&D, and especially not in basic research. And here, I will show you, this is the R&D expenditure as a percent of GDP. The blue line is U.S., this red line is China. You can see it's still below the U.S., and even this target at 2020 is still quite low, and these other countries are much higher GDP. But what is even more pronounced is the, well, I think this chart is interesting. This chart basically shows you that the number of patents you can generate, that you are granted, is really, roughly speaking, a function of how much R&D capital you have. That's how much cumulative R&D investment you have made. Okay, and this is, you put many countries together, and this line is very obvious. But this actually is an interesting chart. This is the percentage of R&D in basic research as a percent of total R&D expenditure. This is the U.S., quite respectable, and 15%. Some other countries are higher. This is China, is actually not quite 5%. Now, basic research is actually very critical for breakthrough discoveries and inventions. If you don't have basic research, you can make a lot of marginal improvements, but you can never, very rarely can you make a breakthrough discovery. But basic research also has the problem that you can't expect any financial returns, not for a long time. So most basic research has to be financed by the government or by some nonprofit organization. I mean, no profit-making organization will want to support basic research. Some did, but they are monopolistic enterprises. A famous example is Bell Labs, when AT&T was a monopoly. So it can afford to, Bell Labs was no longer. It can afford to support Bell Labs. And there is a very famous Xerox PARC, Xerox Palo Alto Research Center, which again, Xerox was a monopoly at the time for plain paper copy. So anyway, so China really has still a lot of work to do. Now, I think the way to really avoid a real war is to try to promote mutual economic interdependence. And that's to increase the economic interaction exchange between the two. Because China and the U.S. are actually very complementary. Okay, China has a lot of labor, U.S. doesn't. U.S. has a lot of land resources. China doesn't have enough land, and China has high savings, and in fact, I think China has excess savings because people are investing in things that excess capacity everywhere. But U.S. has very low savings. So in some real sense, the two countries can really win by really making use of their complementarities. And actually, finally, I want to say that really the increasing the mutual economic interdependence would reduce the probability of armed conflict in the future. Okay, just to make sure that they can't do it. I mean, it's just like France and Germany. You cannot imagine a war can break out between France and Germany today because they are so locked in after the Second World War economically. Okay, and I think that what I want to say is the following: if China and the U.S. can cooperate and work together, many global problems, such as prevention of climate change and denuclearization, can be solved. All right. But if two countries compete in a friendly way, much innovation is possible, just like what I said about a supercomputer. I think the two countries should aim to become competitive but partners. Okay, so it's not strategic competitors, but competitive in both sense. But they also should be partnerships. For example, a Mars expedition, should China and U.S. can join in the Mars expedition together with other countries, because there's really no reason to have a duplication when you can pool resources. Someone told me that it would cost $200 to $300 billion to send something to Mars, right? And there's no reason for both countries to do it. They should just do it together and just send one rocket to Mars. Okay, let me stop at this point, and I'll be happy to take questions. Thank you.
Okay, now we open to the floor for Q&A. Please raise your hand. We'll take questions one by one, okay?
Thank you, Professor Lau. I have actually two questions, one on economic and one on politics. The first one is, I think the trade deficit in the U.S. is a multilateral problem, but not a bilateral problem between China and U.S. Unless the Americans save more and spend less. Otherwise, the trade deficit problem is only a zero-sum game. The trade deficit with China can only shift to other countries like Vietnam, Bangladesh, etc. So the overall problem, trade deficit problem, cannot be solved. Do you agree with this argument? That's my first point. And the second point is, in your presentation, China is the villain or the enemy of the U.S. because of the Donald Trump's election. In the past, Russia used to be the common enemy of the U.S. But over the past 2 years, it seems that the China replaced Russia as the enemy of the U.S. So can you give us some insight about the relationship between U.S. and Russia? Thank you.
The first question is actually very good. And I agree with you. That is, if the trade does not create any new trade, does not create new production in the U.S., it's basically cosmetic, right? You're shifting from one to the other. I mean, for example, if China wants to buy more natural gas from the U.S., now, if the U.S. simply diverts what is now selling to Japan to China, it doesn't really help the U.S., right? But the bilateral balance will look better, right? But the aggregate balance will be the same. Okay. But what I want to emphasize is the following: is that it is possible for the U.S. to basically produce new output and to supply the new demand. So what you need to do is have new supply and new demand. An example would be natural gas from Alaska. Okay, it has yet to be exploited, right? So if the U.S. and China can come to a long-term contract on liquefied natural gas from Alaska, this is new production. So it would be new GDP produced in the U.S., and it would not be at the expense of current exports, right? So this would actually, be different from the situation described. So the success of this, making it win-win, would basically depend on new supply forthcoming and new demand. But in order for that to happen, it really has to be long-term, right? No one in Alaska is going to just sell 1 year and stop, right? Because it's too expensive to develop natural gas, right? And from Chinese point of view, they want long-term dependable supply, right? 1 year you might have just buy the spot market. It doesn't help you that much, right? So I think there's room for this to happen, and that is very much because the market is not complete. Okay, so without some sort of bilateral agreement on supply and demand, it won't happen. Right. So I think that in general, I don't disagree with what you said. But if you can engineer it so that there's new production and new demand, then the situation is different. Okay. And the same applies to agriculture. Let's say if China decides to buy more beef from the U.S., you know, I mean, just let the U.S. have plenty of land. They can raise cattle and so forth, right? That has to be long term because no American farmer is going to raise more cattle just for 1 year, right? You know, so again, you need to encourage, promote the long-term supply on this side and long-term demand on the other side. So that's my answer to your first question. The second question actually is reasonably accurate in the following sense, because I also mentioned that geopolitics have changed, right? And you know the in some sense, the United States has realized that it doesn't have to be nice to people, right? Okay, as long as you're fighting the Soviet Union, fighting somebody, you need to be nice to other people, or nicer to other people. But once this is, you know, I mean, no threat, then you can afford not to be nice, not be so nice, right? And I think that's really what's happening. But I think what you touch on is really something that Eisenhower pointed out a long time ago, called the military-industrial complex in the U.S. You need a hypothetical enemy to increase the defense budget, right? You know, if you have peace everywhere, why do you need more airplanes, more bombers, you know, I mean, more missiles, you know, and you need, because that's actually, you know, President Eisenhower, basically identified the military-industrial complex, and it's still there, right? You know, so unless, you know, so this is the reason to have higher defense budget, right? You know, and for that, you really need a hypothetical enemy, right, to justify, you know, the increased expenses. So I think that is that's not a problem that's easily resolved. You know, Eisenhower spoke out in the 50s, 1950s, right? This is 2018, right? And it's still very powerful. Vested interests in every country is very powerful. Someone asked me about reform, how easy or how difficult it is to reform. I said, one of the things that has happened is that 40 years ago, there were very few vested interests in China. So reform is actually much more straightforward, right? Today, I mean, there are all sorts of vested interests in China too, right? So when you have vested interests, I mean, they will protect their own interests, right? So I think in some sense, reform today can be much harder, even though the country is much wealthier. You know, in some sense, you can afford to support, you know, unemployed workers much more easily today than, say, in the 90s, right? But on the other hand, there are more vested interests. So it's in the U.S. it's sort of, you know, a little similar because the military-industrial complex is very strong. Last night I had dinner with an American friend. He told me something interesting. He said that he worked for the government. He said he's not getting a paycheck because the government shut down. But he said all the troops are being paid. The Defense Department is not touched by the shutdown. Okay. So anyhow, all right. Okay. Thanks.
I think you got a very good speech from an economic perspective. But somebody said this is not just a trade war. This is a long-term ideology war because the U.S. basically is the leader
No, I think that's a good question. I'm sure that that enters in the picture. But I think on average, Americans are not that ideologically, are not that ideological. They are very pragmatic. I mean, there are people, you talk to Steve Bannon, he would take that point of view, right? But most Americans are very pragmatic. I'm sure Trump doesn't think that way. I don't think Trump thinks that he can change the Chinese at all, right? Because I think it is inevitable that every country will eventually choose its own way, right? I think it's unrealistic to think that you can make another country adopt your way. There are too many examples of failure, right? And I don't think Trump will try to change any country. There may be some people who might still want to try, but I think history has proved that really doesn't quite work, unless you're prepared to stay for 50 years, right? It doesn't quite work. So I think there might be people who think that they might be able to change, and they put enough pressure. Maybe China would give up socialism. I really don't think so. I think the time for that kind of pressure to work has passed. Right. Okay. Glenn?
Thank you very much. Great speech in your book, and looking toward, as you stand there, looking toward the next 6 weeks, March 2nd.
Yes.
What, in your mind, could be the grand bargain that strikes the deal? And with that deal, would it be quickly going back to normal or even accelerate because there's certainty? And would this stimulate more reform in China because of more marketization? There's the pressure on state-owned enterprises and that sort of thing. And would China then, would other countries want the same that America gets, as it were? Will it influence China's trade relations with other countries? Thank you.
Thank you, Glenn. The answer to the last part is easy. First, I think whatever China grants the U.S. will be granted to everybody. Okay, I believe that, because I think at this juncture, it is actually in China's interest to, like I said, to be open, to be as open as possible. The real danger is to become isolated. Okay. Now, if you think about the U.S., Mexico, Canada agreement, right? And in that agreement, there is really there's a clause which says that if Canada or Mexico, maybe in the U.S. as well, were to enter into a free trade agreement with any non-market economy, okay, then it has to have the approval of the U.S., perhaps the others, right? So you can see that who is this? Which economy is the non-market economy, right? That's obviously China, right? Yeah. So I think for China, I think the real risk is to become isolated, right? And that's why I think China will actually continue to support multilateral organizations like the WTO rules and so forth. We collaborate with the Europeans and so forth. So I think that part is easy. If they grant the U.S. anything, it will be open to everybody. Right, it will be open to everybody. Okay. Now, I think, as I said, I think the competition between, I would like to use the word competition rather than rivalry, okay? But competition is going to continue for a long time. All right, and so there won't be a grand bargain, right? So it would be a fix-up, and I think, like I said, the intellectual property rights issue can probably be solved, right? And forced technology transfer should disappear, right? And cyber theft is a little tricky, but actually, there are hackers everywhere in the world attacking from whichever direction, and I think it actually makes some sense to have a global treaty, on cybersecurity, right? That is, everybody will sign and say that if we catch anybody, we'll catch anybody who did it, right? So I think that makes sense because we have hackers everywhere, and everyone is at risk, right? So I think something like that could happen. Spying will continue, right, in every direction. I think that we can't do anything about. But I think that I think President Trump would like to have something that he could say, he could declare victory, right? But it doesn't have to be a comprehensive victory because it's not going to happen, right? It would be the same kind of victory that he declared when he met with Mr. Kim, right? Right? So long as he says it's victory, everybody say, yeah, that's a victory. It's good enough. But I think it would be more substantive than that. But I don't really think that it would really be a grand bargain. I think market opening is good. You say, I have one idea which I think is very good, but I don't think it's going to happen. And that is, if you think about the U.S., Amazon is now so powerful in the U.S., right? And Alibaba is now so powerful in China. I think the two governments should simply say, Alibaba can go into the U.S. market and Amazon can come into the Chinese market. I think that would greatly improve consumer welfare in both countries, right? But I don't think it's going to happen. Right? So anyhow.
Okay, let's pick up one question from this side.
Thank you, Professor Lau, for the wonderful presentation. I guess I just have a question on a chart. You showed a chart about the basic research, right, and it showed China is much lower than its peers.
Yeah.
At the same time, I believe on that chart, China's per capita GDP is also slightly below its other peers in the chart.
Yes.
So I just want to understand, want to get your opinion on the reason behind this very low basic research investment. Is it because of for example, the development stage of China, or does it reflect some priorities of the government?
I think it's because because of basically impatience. You see, basic research typically would be financed by the government. Okay, but the government has to take a very long view on what constitute returns, right? Basically, no returns. You have to accept the fact that basic research has no short-term returns, right? And the return is very nebulous in the future, but we know it happens, right? And I think the problem really is that we really don't have, for whatever reasons, the Chinese bureaucrats that hands out the money, they insist on the report every year, right? I mean, you can't do the basic research and expect next year I found something. Usually it doesn't happen, right? So I think the way to change it is really to accept the fact that you may not see anything. And if you see something in 5 years, you're lucky, right? So I think that is really a state of mind. I think in the 60s in the US, I actually began using the ARPANET, okay, which is the precursor to the internet. But it really did not become commonly used until the 90s, right? And that's really how much lead time you would have to provide for something that's really breakthrough. I think the only thing is really to say, there is a, I don't know whether you've heard of the MacArthur Fellows in the US. MacArthur Fellows are great. So if you're young enough, you should all apply MacArthur Fellows because they pay you for 5 years. And you don't have to do anything. I mean, they pay you for 5 years. And these are every year. I actually have been asked to nominate people in the past, but not recently. But I think you have to be young, right? And they just say this guy is promising, or this lady is promising. They provide 5 years of salary, right, and no demands. So the idea is that you will use the 5 years to do whatever you think is right in your field, right? You really need to take that point of view to do basic research, right? And I think for complicated reasons, but I think the bureaucrats, they feel that they have to have something to report to the boss. I also, at one time in China, the government wanted to invest in venture capital. And I said, no. I said, you don't really want to invest in venture capital because 9 out of 10 investments fail, right? You don't want to report to the premier and say, I'm sorry, I invested in 10 investments, 9 of them went broke, right? You don't want to do that. So it's not something that the government can very well do, is to generate things that have no return, right? I mean, you really have to change the mentality to be able to do that. I actually think that China really should invest much more in basic research. I mean, don't get me wrong, I think Chinese are very ingenious. I think one of the things I like best is WeChat Pay, right? You know, they even begging for money much easier than before. You know, in China, some of you may not know this, there is actually no personal checking accounts, none. So for me to try to give money to Glenn, I have to go to the bank, withdraw money, give it to him, and he would go to the bank and deposit money, right? It's just, you know, I mean, think of the transactions cost doing that. And now all we need is a QR code, right? And then we can transfer, right? And I think that's a great innovation. But that is really not a basic breakthrough, right? It's really on an application that facilitates consumer, right? And it's very ingenious, but you're not going to go to the frontier of science and technology, right? By doing that, right? I mean, so I think that it's important to channel the energy, the efforts into, you know, something more breakthrough. So one of the things that we hope to have a breakthrough is fusion energy, nuclear fusion, right? Nuclear fusion, if you can successful, that would mean that there's no pollution anymore. The fossil fuels would be finished, right? You know, so I think something like that, but that really requires basic research to have a breakthrough.
Okay. Because of the time constraints, yeah, this will be the final question. So we give the pity to the lady there.
Thank you. A quick one. Thank you, Professor Lau, for a wonderful presentation. I just wonder, there has been a lot of questions and doubts regarding the GDP calculation methodology for Chinese government. And I just want to probably shed some light on the data integrity for the statistics that are running in China.
As far, I mean, I have to say that I am international advisor to the National Bureau of Statistics. Okay, but I would have to tell you that first. But I would tell you something, that it actually is no good to make up numbers because you also fool yourself. Okay, and China really learned this lesson in 1958-59. Okay, in the Great Leap Forward. No, I mean, you know, they look at these reports. U.S. way up. So they actually reduced the land, the land to be cultivated in the following year. It turned out to be all made up. So it's a very expensive lesson to make up numbers. Okay. Now, the other thing I want to tell you is this. I actually trust the National Bureau of Statistics. And if you actually go and look at every year, there's an annual statistical yearbook, right? And do the following calculation. Calculate the weighted average of all the provincial growth rates, okay? If you weight them by GDP, and it should come out to be exactly the same as the national growth rate, right? You have the individual provinces, you have the weights, you take the weighted average of growth rates, it should be exactly equal to the national rate, right? Okay, but what you would find is that for more than 20 years, the weighted average of provincial growth rates is about 1 to 2% higher than the national growth rate, which means that the provinces have been exaggerating their growth rate. And the National Bureau of Statistics, saw fit to do their own estimation. So I don't think, I think basically they are really quite reliable. I don't think there's any systematic falsification of data because they actually try to adjust the provincial data. But what is really quite interesting is that they don't try to correct the provincial numbers. They publish them as they were turned in, right? Okay. Now, but I should add that maybe it's not all falsification on the part of provinces, because I think if you actually go and try to calculate California GDP, it's very hard. Why is it hard? Because there's no custom barrier between California and Nevada, California, Oregon, and the other states. So it's almost impossible to calculate precisely exports from California and imports to California. And you can't get X minus M correctly. You cannot get GDP correctly, right? So, I mean, just a long way of telling you that I don't think there's much cheating. Now, I know that there are some economic firms that actually publish numbers that says there's cheating. See, I think they are actually making a fundamental error by assuming that the structure remains the same, okay? Because over a period of time, in the last 5 years, energy per unit GDP has been coming down, right? That's first one thing. It's due to two effects. One is in the manufacturing sector, it's become more efficient. But the other thing is that there's also changing composition because the service sector is now the largest in China. Manufacturing has come down. So if you use the old adjustments, they actually don't work anymore. Okay, so I mean, I remain open to see new evidence, but I think that I don't think there's any credible evidence that the National Bureau of Statistics is picking up the numbers. Okay.
Okay. So we have to stop here. So please join me again to thank Professor Lau for his wonderful talk and his